To watch the full lecture of all subjects, kindly subscribe to my YouTube channel and press the bell icon because whenever I post the new videos, you will get the immediate notifications.
Hello everyone, welcome to my YouTube channel. In this particular video, let us discuss about the scope of financial management and what are the decisions are there in financial management as well as importance of financial management. Now we have 8 scope or functions of financial management. Let us discuss about all these 8 in detail. First one is estimating the financial requirements. Now the financial manager, okay, who is the head of the financial department, he need to estimate the financial needs of the company. So now how he can estimate means we have something called as financial statements. In that we have income statement, we do budgeting, okay, and we have something called as this is income statement. I'll write it fully. This is income statements. Then budget we would have done. We have balance sheet. Studying all these things, the financial manager can know the financial needs of the organization. Simply he cannot say that the organization needs 50,000 fund. So he need to check into income statement, he need to check the budget, whatever the company has prepared for that particular financial year. Then previous year balance sheet you need to check. Then he'll have a clear picture on the expenses, on the investment, okay, all these things he will get the clear picture. ಈಗ ಫಿನಾನ್ಷಿಯಲ್ ಮ್ಯಾನೇಜರ್ ಕಂಪನಿಗೆ ಎಷ್ಟು ದುಡ್ಡು ಬೇಕು ಅಂತ ತಿಳ್ಕೊಳ್ಬೇಕು ಅಂದ್ರೆ ಆತ ಇನ್ಕಮ್ ಸ್ಟೇಟ್ಮೆಂಟ್ ನ ನೋಡ್ಬೇಕಾಗತ್ತೆ, ಬಜೆಟ್ ನ ನೋಡ್ಬೇಕಾಗತ್ತೆ, ಬ್ಯಾಲೆನ್ಸ್ ಶೀಟ್ ನ ನೋಡ್ಬೇಕಾಗತ್ತೆ. ದಟ್ ಈಸ್ ವಾಟ್ ಹಿಯರ್ ದೇ ಹ್ಯಾವ್ ಗಿವನ್. He anticipates the financial needs by referring various documents. So all these various documents he will observe, then he will get to know the economic condition of the business, then he can guess the amount of fund required by the organization. Okay, so for that a budget is prepared. So before only well advancedly they prepare the budget to know what is the financial needs of the organization. The second function or scope is deciding the capital structure. Now we have many options. Okay, when we look into the options, we have equity shares, the financial manager has preference shares, okay, then debentures are there, okay, loan is there. So now what happens, we have a financial manager, he should know in what ratio he need to take the fund from each of the sources. So we call this as debt equity ratio. Debt equity ratio. So he need to decide how much capital to raise from equity shares, how much capital to raise from preference shares, how much fund to raise from debentures, and how much loan has to be raised from the debentures. So this implies the proportion of equity and debt. Okay, judicious mixture of equity and debt will result in minimizing the cost and maximizing return. Now he will choose a ratio between equity and debt. So what happened, this ratio should give minimum cost, should be minimum cost, but it should give maximum returns to the organization. ಈ ಡೆತ್ ಈಕ್ವಿಟಿ ರೇಷಿಯೋನ ಏನು ಫಿನಾನ್ಷಿಯಲ್ ಮ್ಯಾನೇಜರ್ ಚೂಸ್ ಮಾಡ್ತಾರಲ್ಲ ಅದು ಕಾಸ್ಟ್ ವೈಸ್ ನೋಡೋದಾದ್ರೆ ಕಮ್ಮಿ ಇರಬೇಕು, ಬಟ್ ರಿಟರ್ನ್ಸ್ ವೈಸ್ ನೋಡೋದಾದ್ರೆ ಜಾಸ್ತಿ ಇರಬೇಕಾಗತ್ತೆ. This is the second scope. The third scope is selecting sources of fund. So what happened, the sources of fund, so firm has to decide when, where and how to obtain the fund that they need. So what happened is, now today let me think, it is 25th December. By 1st of January I require 50,000 rupees fund. So financial manager, at least by 31st December the fund should be ready. The fund should be ready. So in this 5 days of time he need to very carefully think about raising the fund from equity, from preference, from debentures, various options he is having. So he need to know when he need to acquire the fund, at what time he need to acquire the fund, how we need to acquire the fund. It is a duty of him to decide. Then the fund should be acquired before the need arises. For example, I want the fund on 1st January means 31st December the fund should be ready. If you say that I will give you the fund after 1st January, that is on 5th January, there is no use. So the fund should be ready before the need arises. ಇವಾಗ 1st January ಫಂಡ್ ಬೇಕಾಗಿರುತ್ತೆ ಅಂದ್ರೆ ಅಟ್ಲೀಸ್ಟ್ ಬೈ 31st December ಫಂಡ್ ರೆಡಿ ಇರಬೇಕು. 1ನೇ ತಾರೀಕು ಬೇಕಾಗಿರೋ ಫಂಡ್ ನ 5ನೇ ತಾರೀಕು ಕೊಟ್ರೆ ಯೂಸ್ ಬರೋದಿಲ್ಲ. Next, you should know what are the different sources are available and in what proportion you need to acquire the fund from each sources. So we have two sources. One is short-term sources we have, and second one we have long-term sources. So the financial manager should know out of these two how much fund he need to acquire from each of the sources. The fourth scope is what happens is now simply whatever the now by chance he will take 1 lakh rupees fund he has acquired. Okay, in that 50,000 fund is utilized, 50,000 amount fund is utilized. Now remaining 50,000 should not be kept idle. It should not be kept idle. It should be invested. So again, when it comes to the investment, we have something called as short-term investments, okay, and there are long-term investments. So the financial manager should properly utilize the remaining amount to invest in some other businesses which gives more returns for him. Again, you need to plan well for short-term investments as well as long-term investments. Accordingly, you should invest in the profitable areas. You should know what are the short terms, medium terms, and long terms. Based on that, you need to invest the idle fund. Next scope is cash management and profit management. So, as I told you that he will be investing the funds in the various investments activities. So he should keep a careful eye on whether whatever the investments he has made, whether it is going according to the plan or not, or whether any deviations are there. He should watch the performance of each rupee, whatever the single rupee he has invested in the other businesses. He should have a careful watch on that. So whatever the flow of funds, so what happens, there is inflow and outflow. Inflow and outflow of funds will be there in the organization. Both inflow and outflow funds the financial manager has to watch. Inflow ಮತ್ತೆ outflow. Inflow ಅಂದ್ರೆ business ಗೆ ಬರುವಂತ ದುಡ್ಡು, outflow ಅಂದ್ರೆ business ಇಂದ ಆಚೆ ಹೋಗ್ತಿರೋ ದುಡ್ಡು. ಎರಡರ ಮೇಲೂ ಕೂಡ ಕಣ್ಣನ್ನ ಇಟ್ಟಿರಬೇಕಾಗುತ್ತೆ. Next, what happens, he should supply the funds according to the financial requirements. As and how the financial requirements arises in the organization, based on that he need to supply the funds for the organization. Next scope is to ensure liquidity. So liquidity means he should keep some liquid cash for emergency. Suddenly the cash requirement may come, so for that this liquidity, ensured liquid cash can be used. Next is implementing financial control. The funds are to be administered. Once he has administered from where to get, how to get, where to utilize everything, so he need to compare with the actual performance and standard set. So now what happens, there will be something called as budget, or we can call it as standard. Means you would have planned that it will go like this, and there's a second thing called as actual performance. It would have gone like this. So you need to compare between what you had planned and how it went on. So between those two you need to compare. That is a duty. Then only you will get to know how efficiently you have utilized the funds. The return on investment must be continuous and consistent. It is not like one time you get the returns and second time you don't get. No, it should be consistently you should get the return on whatever the investments you have made. By chance if any deviations are there, it is not going according to your plan, how your plan is not going accordingly, then certain necessary actions need to be taken against that. Whatever the actions you want, you can take against that. The last scope of the financial management is surpluses are to be utilized in effective and profitable areas. As I told you, if 1 lakh fund is there, 50,000 you have utilized, remaining 50,000, okay, you will invest. So as I told you, but what happens in this 50,000 whatever you have invested, you will get the returns of 10,000. So that is known as surplus, extra money you have got. So that surplus you should again try to invest in the profitable areas. So what happens in this 10,000, you should even keep certain amount called as provisions, okay, so that any future uncertainties can be easily met. That is what they have given in the second part. Provisions are created out of surpluses to face the future contingencies. These were all about the scope of financial management. Now let us speak about the decisions in financial management. We have three types of decisions: investment decisions, financing decisions, and dividend decision. Now what is this investment decision means? So deciding the pattern of investment decision. Now what happens, you have acquired the fund and 50,000 fund is there in your hand. That fund we need to plan for investing it. So we have again three types, that is short term, medium term, and long term. In each of them there will be risks as well as returns. So the financial manager should know how much to invest in the short terms, how much to invest in the medium term investments, and how much to invest in the long terms. He should know what are the risks in short term, what are the risks in medium term, what are the risks in long term. At the same time, he should even anticipate the returns he will get from short term, returns he will get from medium term, as well as returns he will get from long term. This all should be assessed. That is what here they have given. The activity of deciding the pattern of investment, in which ways he will invest, whether he will invest in equity shares or whether he will invest in preference shares or debentures, etc. So he need to cover, he need to think about both the short-term investments as well as long-term investments. So he should invest in such a way that it will give him maximum amount of returns and higher rate of returns for the business concern. So as I told you that you need to even think about the risks involved, whatever the uncertainties it is involved. The variability of each proposal must be examined with the help of various tools such as capital budgeting, cost volume profit, that is CVP analysis. What it says means we have one source of investment, that is by purchasing equity shares, okay, and we have second thing preference shares or debentures, okay. Now what happens, this may, equity shares has a risk as well as return. Preference shares we need to take certain amount of risks as well as accordingly we will get the returns. Even the debentures we need to take the risks and we will get the returns. Each thing should be judged properly and the best thing should be selected. Next is financing decisions. It is a very important decision. So what happened, different proposals will be there. Like now I have three different proposals. First one is to raise all the funds from equity shares. Second one is equity plus preference. Third one is equity plus preference plus debenture. So we call it as proposal. Proposal 1, proposal 2, and proposal 3. I need to decide which is the best proposal, which proposal gives me more number of returns by taking less amount of risk. So the appropriate mix of finance with debt to equity directly contributes to the profitability of business. If it chooses the best proposal, then it gives maximum benefit to the businesses. So what happens, whatever the instruments or whatever the source of financing he chooses, that should give the maximum returns to the organization, to the investors also. Next is the role of manager is to decide the combination of capital, whether he will go to equity or preference or debentures or bank loans, etc. So various sources are there. From these various sources, you need to select the best capital structure. Next is combination of financial structure is, as I told you, we have equity or equity plus debt we have, or equity plus debt plus preference shares you can take, or equity shares, debt, preference shares, and whereas public deposits. These are all the combination the investor or the financial manager can choose in this particular while planning the financial structure. Last one is dividend decision. What is this dividend division decision means? What happens? The company will have certain shareholders who would have invested in shares of the company. For the shareholders, the company should pay certain amount called as dividend. Now, to decide how much dividend to pay, that is known as dividend decisions. The disbursement of profit back to the investors who supplied capital to the firm. Now, the shareholders would have provided capital for us, and every year we have to pay a certain amount of dividend for them. So, deciding how much to give. Okay. Next, how much of profit earned by the company after paying taxes. So, after paying taxes, the first will be preference shares will get the dividend. Next, equity shareholders will be getting the dividend. So, once the taxes and all is paid, next the company should decide how much profit is left over. In that, how much preference shareholders they will get and how much equity shareholders will get. Some part of the profit should be retained in the business. There's something called as retained earnings, means you will accumulate the profit in that. So every year you will keep some part of the profit in the retained earnings, so that any future uncertainties happens, you can use that funds for that. So some part of the profit should be kept as retained earnings. Next, you need to fulfill the equity shareholders. They'll be happy if they get higher rate of dividends. So you should always make sure that your shareholders are happy. Next, the ultimate objective of business concern is to fulfill the desire of equity shares. How the equity shares will be desires will be fulfilled? One is when they get the higher rate of dividend, they'll be very much happy. Then capital gains, if the increase is there in capital gains, they'll be happy. So when more amount of cash dividend is paid for the shareholders, okay, it will be the shareholders will be happy. Next, you need to even choose how much the fund should be retained, that is retained earnings. As I told you, retained earnings. Next, stable dividend rate. It is not like that one year you give higher dividend and next year there's a downfall. No, the stable consistent rate of dividend should be given to the shareholders. Management should always keep in their mind that the psychology of the investor is that the person will be expecting always the maximum returns. So that should be carefully thought by the financial manager. There is one more decision, that is current asset management decision. See, it is also called as working capital management decision. Means the finance manager should also know how to manage the current assets, and he should know how to have the liquidity in the businesses. So what happens? There'll be very small financial needs or current financial needs. So he need to know how to handle these current financial needs, and he can, so that the maximum productions can be maintained and even the efficiency can be achieved. So current financial needs also should be taken care by the financial manager. Next, let us discuss about the importance of financial management. Why financial management is important? The first one is it will help to organize the finance of the organization. The finance will be properly organized, like how to use, how to acquire, everything. Next is it is a borrowed money, means it is the money of some other person, and in future we have to pay them back. So we have more responsibility in taking care of that money in a very systematic and very efficient manner. Okay. Next is we need to make some financial decisions. So to make certain financial decisions, the financial management is necessary. So what happens? They need to prepare the financial reports, and that financial reports should be up to date. So for making this financial reports up to date, the financial management is required. So what happens when financial management is taken, it will ensure that the company is legally following all the financial aspects and it is fulfilling all the legal requirements. Okay, so what happens simply if no financial management is there, not there, every company, all the department will work as how they want. So the proper budget will not be prepared. So in order to have the proper inflow and outflow of funds, so the financial management is required. This was all about the scope of financial management, decisions in financial management, as well as importance in financial management. Hope you have understood about this video very well. If you have any doubts or queries, please put in the comment box. I'll respond to your doubts as soon as possible. Thank you for watching the video. I'll come back with the next video.
If you have any queries regarding today's session, kindly send your queries to education.mbroadcast@gmail.com.